One, Dukadaya area. Investment appraisal.
Dukadaya.
Meaning that areas that you have to be conk on before you get to the exam. Investment appraisal with his brother, business finance. Then business valuation. So investment appraisal, business valuation. Then we come to issues in relation to treasury. Treasury management. Then we come to
when I say business valuation, I mean acquisition and merger, right?
corporate financial restructuring, and corporate reorganization. $25, 50, 20, 70, 15, 85. They are kind of a theory area. And no meaning theory, theory. So this is my question to you, as we did in the corporate reporting class. Which of these areas will be able to train? Right now, as you sit down, you can answer questions on without breathing.
All of them you can
Literally without breathing. Otherwise, there is nothing like that. You just cross your leg. Risk management, I won't blame you because we are yet to actually go to treasury management. We are yet to discuss that.
Financial restructuring is just written.
No, that is the calculation aspect. The reorganization is the rating. So which of these areas do you see yourself that you're good at right now as you sit down? Which of these areas would you say you are good at? No. Right now, as you sit down there, as we did in corporate reporting, there were areas that like you were comfortable. So right now, what would you say?
The acquisition and measures and the financial reconstruction and reorganization.
So,
but I have challenges there.
Well,
acquisition and measures.
Acquisition and measures. You know, that's what I said. It's about the business valuations. Okay. And then financial restructuring. Okay. Yes, John. What do you think?
The first one is
investment appraisal and business finance. You are strong there. Somehow strong. So it's called.
It's just that we will not reply. It's a business valuation.
Okay.
And
Okay. Strong. Always, what do you think?
Yeah, at least business valuation and financial reconstruction and corporate reorganization.
Comfortable.
Yeah.
At
least you can do something.
You can do something there. But investment appraisal,
I've read, but I haven't started solving questions.
question on that one. Derek, what's your problem in the business valuation?
Yeah, you know, in the book, they are doing something like beta, some asset beta. Some
Yeah,
beta
re-GRA.
is in some way it's confusing.
It's not confusing, it's very simple.
The beta some
This is
it's
it.
an entire trend. They have
This
that
is it.
their position.
This is it. That's called diversification, and it is in this question we'll be solving it.
Okay.
It is when the business is investing or going to invest or buy a company which is not in their industry, and they are appraising it. Are you getting it? That project. When they are doing that, what they do is that they have to calculate the gearing for that industry and use that to re-gear their cost of capital, their camp, and use that camp to now come and value the company. Are you getting the idea? So you calculate the equity beta for the industry, use that to come and calculate our beta, then we will now use that beta to calculate what? The camp. That is what we will now use to appraise the project. So we will solve a similar thing like that in this question. Then maybe
What do you mean with the asset beta and the equity beta?
right, the asset beta relates to the investment we are making for the company. The equity beta relates to the shares of the company. So equity beta has to do with shareholders' perspective, but asset beta has to do with the entire business. Are you getting the idea? So we will solve a similar thing like that in this very question that we are about to tackle. Then I hope that that thing will be dealt with. Now, so as I always tell you, the approach you're going to be adopting in corporate advanced financial management is, depending on the question, you can try this guy first, depending on the question on this guy. Here, these two, you can go for them easily first. Remember, always go for the easy marks first. Easy mark also here. This guy sometimes is skeletal, okay? Sometimes he's skeletal, so if there is theory, you can easily answer fine. But go for the easy marks first. And remember, I mentioned that fifth area will be a theory question, which is under economic environment for multinational companies. And that is a theory area. If you know, you're right. If you don't know, you can go away for it. But if you're able to do investment appraisal, you are able to do the business valuation question, you are able to look at the reconstruction and reorganization and a bit treasury, at least you should be able to go through the exam. So this question we have before us will help us to deal with investment appraisal. After I solve this question, that 25 marks, you are taking it. No excuse. You are taking it. Because everything examinable by the examiner in relation to investment appraisal is in this question. So I'm going to deal with it, and then we take that header up. So Elvis, it will help you. Since you say you've not solved any question, it will help you. Then John, you also have not revised on that well. It will also help you. So let's look at a question there on, and then let's see how we go by there on. Very exhaustive question, but we're going to try and read all of them, and then we will get the key things. Remember what I told you? One of the things you do is you don't finish reading the questions because it looks too much. But finish reading them is what will help you to answer it. So let's look at the room. You have your question paper. Was he here when we did the test? Yeah, you were here. You were not here when we did the test. Okay, so let me check that case. So let's look at it. Deron, question 2. So Deron is a listed company located in an European country. Its senior management are reviewing the company's medium-term prospects. The company is heavily dependent on a single product. A general election will take place in the near future, and the managers believe that the future level of inflation will depend upon the results of the election. Inflation is expected to remain at approximately 5% if Party A, that is the political party in power now, wins. the election or will quickly move to 10% per year if Party B wins the election, opposition leaders. Opinion polls suggest that there is a 40% chances of Party B winning. Okay. So what is happening here? In the brief scenario that the examiner has told us that two things are necessary. That our future prospect is based on what? The election about. And there are two things here, inflation for the Party A, inflation for what? The Party B. Projected financial data for the next 5 years, including expected inflation, where relevant, are shown below. Now, so the first thing is when Party A wins and the inflation is what? 5%. And these are the cash flows given. Now, there is sales, there is variable cost, there is fixed cost, there is incremental working capital. Do you see that there is an asterisk there? Yes. Come to the other side and look below here. You will see the asterisk there, and the examiner said that a bracket signifies what? A decrease in working capital. I have underlined that. Meaning, it's a key thing I have to focus on. Now, a bracket signifies a decrease. When there is a decrease in working capital, how do we treat that in investment appraisal? We add, right? Okay. An increase, we subtract the decrease, we add. It means everything here, we're going to be what? Adding to the cash flow. To the cash flows. When Party B wins, the same issue, and we are seeing what? An incremental here. Okay. But in party B, the first year is +1. Meaning that is what? An increase, isn't it? It's the second year that the reduction begins to what? Come in. Can you see that?
Yes.
Okay.
Yes.
Now let's go to the additional information, which is where the deals are. Tax allowable depreciation will be negligible after IBAZE 20Y1 in both cases. Okay. Taxable cash flows after year Y1, excluding tax savings from taxable depreciation, are expected to be similar to what? Year Y1 cash flow for a period of what? 5 years, after which substantial new fixed investment will be necessary in order to continue what? Operation. Please follow me well here. What's happening? The examiner is not telling us a story, he is telling us the investment. So let's hear what the examiner is saying. The examiner is saying that this is a 5-year project ending at Y1. But after that, he is saying that taxable cash flows after Y1, excluding tax savings from taxable allowance, are expected to be similar to what? Y1. For a period of 5 years. What does that mean? It means Y2, Y3, Y4, and what? Y5. Are you following the ideas? And then Y6. What does that mean? It means the company is actually doing a 10 years project or forecast. I don't know if you saw it. Because 5 years has been given. 20x7 to 20 what? Y1. That is 5 years. Then another 5 years is this one. But the examiner says that the cash flow for these 5 years will be similar to the cash flow of what? 20 Y1, excluding tax allowable what? Depreciation. So I underline that aspect also because it's a key area I have to focus on. Next, how? Yep.
The first line.
Mm-hmm.
Tax allowable depreciation will be negligible.
You see, there is a tax allowable in the A and B. Can you see that thing in the schedule?
Yes.
It means when you are doing the analysis for these guys, you don't bring that tax allowable because you are not supposed to calculate it.
The tax allowable
Yes.
will be negligible after.
Will be negligible.
So it's not necessary.
So we don't consider it. I hope you are getting the idea. Next. However, no replacement investment will be necessary between Y2 and Y6. So you see, they have even told us Y2 and what? Y6. There will be no replacement. So look at it. Do you see replacement cost? Is it in both cases? Yes. Do you see replacement cost in both cases? He says that from Y2 to Y6 there will be what? No replacement cases. In other words, when you finish from 20x7 to 20y1, when you are starting at Y2 to Y6, you are not going to take care of taxable depreciation. You are not going to take care of tax. No, you will take care of tax, but I think you won't take care of allowable depreciation. Then you will not take care of what? The replacement cost. Are you getting the idea? We don't take care of all that. Working capital will remain approximately constant after what? Y1. Listen, approximately constant. Meaning it is not increasing, it is not reducing, it is constant. Corporation tax is what? 30% per year. We are interested in that, so I've underlined it, and is expected to continue at this rate. Tax may be assumed to be payable in the year that income what? Rises. Assuming tax is not payable in the year income rises, then 20x7 tax will be paid in where? X8, X9, Y0, Y1 in that order. But X7 tax will be paid in X7, X8 will be paid in what? X8 in that order. Next. Deron's current ordinary share price is what? 46 centos. We'll come back to the meaning of that thing later. The finance director has received a report from a consultancy firm which includes a prediction that whichever political party wins the election, the independent central bank will have to raise short-term interest rates as a monetary policy measure to prevent the rate of inflation from rising even higher than the 5% or 10% estimated. An increase in interest rate will have a significant adverse effect on consumer demand in the economy. Are we going to buy that? We won't buy anything. We won't buy all the information here, but it's something we will consider later on. The company's remuneration committee has just come up with a new incentive scheme for senior executives, including the grant of company shares. The intention will be to create a pool of shares by repurchasing shares in the stock market and awarding them to executives who meet the performance target. At the moment, the company does not have any long-term incentive scheme for executives, but there are generous bonus schemes based on annual profit performance. The finance director, although a potential beneficiary from this scheme, is concerned about the possible reaction of major shareholders to an announcement of the scheme and the possible financial implication for the company. All the story there, we are not interested in it. Why did the examiner tell you all that? He just told you because he thinks you will think about it. So he just told you about it. So. Next. Summarized financial statement for Deron for the year ended is as follows. What are we interested in here? 1. There is loan falling due after 1 year. That's a current liability, 7%. What is the shares of the company? 5 million. And each share is what? 25 cents. Okay. So what is the number of shares? These are some workings we do at the background. Let's do it on the paper. What will be the number of shares? Divided by 0.25, what will we get? 5 million divided by 0.25. 20 million shares. I hope you know why we are dividing by 0.25.
Yes.
Okay. Next, this is what we need for our question. This is an area we need for our question. The company can currently borrow long-term loan from the bank at an interest rate of what? 10% per year. I'm interested in that. This is likely to quickly rise to 15.5% per year if political party B wins the election. The real risk-free rate, listen carefully, the real risk-free rate excluding inflation is 4% and the real nominal rate is what? 10%. The real return on the market is 10%. Deron's equity beta is 1.25. This is not expected to significantly change if the inflation increases. 3 alternatives available to management of Deron. 1. Recommend the sale of the company now. An informal unpublished offer of 10 million for the company share have been received from competitors. 2. continue existing operations with negligible capital investment for the foreseeable future, or 3, if party A wins the election, diversify operation by buying a going concern in the hotel industry at a cost of 9 million. The purchase will be financed by issue of 10% convertible loan notes. Issue costs are 2% of the gross sum. Daron has no provisions of that. Hey, Radi is. Is it? Are we going to do APV? By all means, there is APV inside. So this question is packed. That's why I want you to follow well. Everything in if I'm able to finish solving this question and you understand it, I'm done with the investment appraisal. I know you can get that 25 mark, hands down. So let's go for it. Last aspect, last page. Financial projection for the hotel purchase has been given to us. So that's all there. We will come to that later. Also, the same information there. But let's come to the requirements A so that at least the meaning will be clear now. Prepare a report advising the senior manager of Daron which any of the 3 alternatives they should recommend to the board of directors for adoption. On your report, you should include comments on any weaknesses or limitation of your data and what? I can't see that thing. Let me go to my question. Yeah, I think my printer didn't come out well.
The report should contain appendices that show how relevant.
Okay, the report should contain appendices that show how relevant calculation, including estimation of present value of future free cash flow from existing operation, estimated adjusted present value of diversifying into the hotel industry, and then the book market value, blah blah blah. Okay, so these are the things. These are the things. So we are supposed to write the reports. Now listen carefully. The first alternative of the company is to, yes? Where are you? Where are you? Yo, what's it? So the first requirement of the first alternative is that recommend the sale of the company now. 2, continue existing operation with negligible capital investment for the foreseeable future. Or 3, if party A wins, we should diversify. So there are a lot of things that come into play here, but the first thing is to calculate the present value if party A wins, present value if party B wins, and present value of the hotel industry. So let's go through it one after the other. Listen carefully and follow the idea. Now this is a 30-mark question. The examiner can compress this question and bring it to 25 marks. Compressing means that obey BBA frame, not the BBA count, but 25 marks. So let's go for it. So all this we are about to do is working. When we finish, we write a report and do the analysis. So A, if party A wins. Now you're going to help me here a lot, okay? Yes, madam.
There's a 40% chance that party B will win. It means it's very likely party A will win. Do I not base the analysis on party A?
You cannot.
Looking at the percentage
of the pool.
Yes.
But you know, opinion poll has always been wrong. Almost always been wrong. Donald Trump shouldn't have won the primary, but he won. Obama shouldn't have been the president, but he became. Donald Trump shouldn't have become president of the United States. Akufo-Addo couldn't have gained one touch by 5 million or 1 million different votes. So opinion polls are always wrong. So in financial terms, even though that thing is there, we will still do the analysis for all of them. But they include that it is highly possible that the A will occur. I hope you are getting that. So let's look at it. So flip over to party A. When party A wins and their inflation is how much? 5%. Now there are things I want you to note. This is where the journey begins. One is that you have to ask yourself, what is the cost of capital in this question? Because we are preparing investment appraisal. We have to find the present value. But what cost of capital do we use here? Yes, anybody with any idea from the question, what cost of capital do we use here? We have to compute it. How do we compute it?
They've given us
If you go to page 6, there was an information there. So let's go to page 6.
interest rates,
What did they give us?
the risk-free rates,
Mm-hmm.
the market rates,
Okay.
and the nominal rates.
Now, so stay with me. Stay with me and make sure you get this well for me. Now, immediately I hear equity beta, it means that I need to calculate capital asset pricing model. That is the KE will be capital asset pricing model, which is the risk-free rate plus the beta into bracket return on the market minus what? The risk-free rate. Follow it carefully. Then we are also told that the company currently borrows at a bank rate of what? 10%. What does that mean? It means there is also KD there. I don't know if you get it. So there is KD there of 10%. But this is the KD before tax. We need to bring KD after tax. What is the tax rate of the company? When we told the tax rate of the company, 30%. So KD after tax will be what? This minus 1 minus 0.3. And so it becomes what? 7%. Are you following me? Yasha say, I don't know. Until KD will now be 7%. We are always interested in KD after tax. Always. Now, if I need to calculate CAM, then, and I need to calculate KD, that means indirectly the examiner has taught me that I should appraise this project using what? WACC, which is value of equity over value of equity plus value of debt times KE, which in this place is the CAM, plus value of debt over value of equity plus value of debt KD. Sounds good? So let's begin. How do we get VE? Value of equity. How do we get value of equity? Where did the examiner say the share price, whatever? Where was that information?
What about where the balance sheet is?
Balance correct ordinary share price is 46 cents.
46 what? Centos, right? So currently the share price is 46 centos. And so that would be 0.46 times, what is the number of shares? 20 million. So what do we have? Derek, you asked a question.
Given the balance sheet over there,
What's the balance sheet?
summarize statement of financial position.
Hi there. The power
The
chart.
value of equity, value of debt.
Where is it? Are you sure it is there?
On the same page.
Yeah, on the same page. No. We're looking at value of equity. No, this is nominal value. The 25 here is the nominal value. But 46 is the share price. So this is the formula. You see, value of equity is market value per share times number of shares, not nominal value per share. The one in the balance sheet is the nominal value. But here we are interested in the market value. So it becomes $0.46 times what? Did you say 20 million? So what do we have? 9.2 million dollars. Are you following the idea? 9.2 million. That is VE. Sorry, but I'm just writing this way, so forgive me. VD. What is the value of debt? What is the debt in the question? Do you see? Go to the balance sheet where Derek was. 6. That's the same place. Page 6. Do you see loan and other borrowing falling due after 1 year? After 1 year. So that means what? That is the debt, the bank loan. So VD will be the 7 million. This one, we don't do any calculation. If it was a debenture note, we would have done a calculation. But it's a bank loan, so the VD will still be what? That figure.
Where is that?
The balance sheet, page 6.
If it was a debenture, what would we do?
Are you there? I have page 6. Is it page 6? No, that's okay. Yeah, is that page 6? Yeah.
Okay.
Was it?
I said if it was a debenture.
Yeah.
What
The debenture, if it was a debenture, VD would have been the market value of the debenture. Maybe the debenture is quoted at 78 over nominal value of debenture, which is always 100, times the nominal value in the balance sheet. That would have given you the value of the debenture. Sounds good? So it is the market value per $100 divided by the $100 nominal or Ghana cedis times the nominal value which will be in the balance sheet. So if it was a debenture, this is how we have gone for it. Okay, so do we have all the preambles now? So we have VE 92, we have VD 7. So let's get VE plus VD. 7 mil plus 9.2 mil. 16.2 mil. But Shadi B Yenya KD Ewaha at 7%. But Yenya campaign. How do we calculate camp? So we need to calculate the camp. Remember, if we are calculating camp, the examiner has given us risk-free rates.
Excuse me, so in this case, what's the difference between the KD and the VD?
What is the KD is cost of debt. VD is value of debt. You got it? What is the risk-free rate given to us in the question? 4%. Can you see that?
Yes.
And then return on the market, RM, 10%. But listen carefully. The examiner said the real rate, meaning excluding inflation. But Shadia say our party area inflation 5%. So we need to now calculate the nominal risk-free rate and the nominal return on the market before we can calculate the camp. We use the Fisher formula here. The Fisher formula is 1 plus I equals 1 plus R, 1 plus what? H. The R is the real rate given to us. The H is the inflation. The I is the money rate we are looking for. So substituting this, if we want to find the RF including inflation, it will be the I. That is what the I is representing. So it will be 1 plus R, 1 plus H minus 1. I don't know if you got it. I don't know if you got it. We are making I the subject. Into this guy will go and become minus 1. Sounds good? Yeah. So let's go for it. 1 plus the real rate given, 0.04, into bracket 1 plus the inflation. We are party A. So 0.05 minus 1. Can you help me out? 1.04 out, 1.05 minus 1. What do I have? Times 100, because it has to be in percentage. 9.2%. Sounds good?
Because multiplying this 1.04 times is
minus 1.
So it's 1.04 times 1.05 minus 1.
Minus 1.
So we have to do brackets here before we subtract. When you do that, it will give you a negative number.
It shouldn't. How did he get positive?
1.04.
1.04 divided by 1.05.
Wow.
Going to do 0.05.
Yeah.
Wow.
0.090.
So times 100.
That one I have.
Are you getting it?
Yes.
Are you following? Are you following so far? So get the idea. Get the idea how we are building up. How we are building up. Now, am I done? No, sir. Why am I not done? Because I need to also get the return on the market, including what? Inflation. Still using the Fisher formula. Because all of these guys are in real terms. But because we are putting inflation in the project, we need to have them in what? Nominal term. So, you don't worry, we will come back to this gentleman in a moment.
This person. This person.
I said if you understand this question, you are done with investment appraisal. So follow it well.
PhD question.
What's a PhD question? No, John, don't say that. Don't say that. It's not a PhD question. How can I bring you a PhD question here?
So, but when we finish, you have to read the question again and then delete those things that we don't need.
Delete those.
So that when it comes to the exams, then we know that this one we don't focus on.
Yes. So that is why when I'm reading, I messed up my paper like that to know the things I need and the things. You know, everything we read here was not really something we needed. So there are a lot of chunk of information that we don't need. So let's go for ring. How would this be? This is 10%, right? So it's going to be 1 plus 0.1 out, 1 plus, inflation is still 5%, isn't it? 0.05 minus 1. What do we have for the real rate?
This one, if they don't tell you, how do you know that you have to convert the, at least for the inflation, for the interest rate, they're fine. But the RM.
How would you know that? Yes.
That
Yes.
was seriously.
Yes. It will be. That is why they're real. Meaning that the examiner expects you that you had read it well to understand that real is different from nominal.
15.5. The real market return is
15.5%. We good? Everybody got that? Now, we can calculate the KE of the company to say that the camp or KE will be the risk-free rate. New thing we just calculated, 15.5% plus, what is our beta? I didn't write beta down. 1.25. It was in the question, right?
Yes, the equity beta is 16.
Okay, let me put it here so that as we are writing, 1.25. So 1.25, bracket open, return on the market. Risk-free rate is 9.2 rather. So 15.5% minus 9.2%. Can I have an answer for my camp?
9.2, not 9.
Okay, 0.2 here. So let me have an answer for my camp. $17%. Is that what everybody is getting?
17.075.
It's okay. So 17%. Yeah, we say no. Says ya bibia shade. Yekita VE. Yekita VD. Yekita VE plus VD. Yekita KD. And I say Yabenya camp. So we substitute it into it. Remember, the one formula, there is 1 minus tax here. But there are 2 ways to deal with the tax. You can deal with the tax when you are calculating KD or deal with the tax in the work formula. I always like to deal with it and bring KD after tax rather. So let's go for it. So my work,
Please, I want to ask.
please ask.
The beta that we are using.
Yeah.
Is it always that we use that be the beta? Is it always equity beta?
Yeah, it's always.
Is it geared or?
No, in this scenario like this, it's the beta for the company. The issue about gearing comes in 2 scenarios. 1, if a company that is not having debt is taking on debt, then they will now calculate a new beta. That will become a geared beta. Are you getting it? Or we are going to invest in another industry. Then we need to calculate the equity beta the asset beta for them. Then we will use it to come and calculate our equity beta gearing, which is what we will bring here to calculate our CAMP. You don't get it? Two scenarios. What's usually used, like in this question, the base one we are using is the equity beta of the company. It means that is the riskiness of the company, the way it is. That's the equity beta. Only shares. It's financed by shares, no debt. But then, when we are taking on loan, it means that our riskiness is going to change. It means we need to calculate a new beta. That will become what? A gearing beta. Also, if we are going to invest in another industry, diversification, then we need to calculate the asset beta for that industry. Then we use that asset beta to re-gear our equity beta to now get what? A new equity beta, which is what we will use to come and calculate our CAMP, which is what we will use to now appraise a project.
Okay, so when we find the asset beta of that company,
We re-gear.
So it will make ours it will make ours geared beta.
Then we come and use that geared beta to come and calculate. So this one is always referred to as the ungeared beta. It doesn't include any debt. It doesn't include any.
Okay, but in case we are taking on debt and want to calculate CAMP,
Yes.
then we have to gear our beta.
That's right.
Okay.
And come and use that here. Let's go for it. Help me out with the substitution so far. Substitution so far. So VE, what's our VE? 9.2. VE plus VB, we got the total answer to be